Hello and welcome to Ellison Legals in case you missed it. Just going to go over last month's posts of July, which was about mortgages. Quickly before I do that, just a couple of webcast disclosures. Ellison Legal has limited liability under a scheme approved by the Professional Standards legislation, and this webcast provides you with general information only. It's not intended to provide you with legal advice, and it shouldn't be taken as legal advice. So please see your legal practitioner for any assistance that you may require that is tailored to your specific situation. So let's go over last month's post. So I'm just having a squiz at that now. In July, we spoke about mortgages, and we have 5 posts that we put out there. The first one was, what is a mortgage? So when we've got our clients who are looking to purchase a property, sometimes if they don't have enough finances to purchase the property outright on their own, they go and get a mortgage. So they contact their bank, their credit union, whatever the case may be, their financier. So we can call them lenders, to see if they're able to get a loan. When a lender provides a loan to you, they're going to want some form of security. So usually it's going to be, not always, but most of the time it's going to be the property that it is that you're buying. That's the security. What happens then is, so they give you the loan, they have the property as security. To secure that, they register their interest on title. And they hold the electronic title deed. So for banks, it's all electronic. If it's you yourself, you probably still have a paper title deed, which they're still issuing to individuals. But with the banks, it's gone all electronic now. If there's anything that you need to do with your title, take out another loan with another bank or whatever, using that as security, you're going to need that bank's or that lender's authority to do that. That's for them to make sure that their interest in your land has not been diminished in any way. So you need their consent to deal with that title. The second post we spoke about is who is involved. So we've got a few different roles, but the main two are the mortgagor and the mortgagee. Who's who? This is something that is often mixed up, and before learning any of this years ago myself, I always used to mix these two up. We've got a mortgagor and a mortgagee. When we have a mortgage, we as the owner are providing the bank a mortgage over our property. So we are giving something, therefore we are called the mortgagor. The bank or the credit union, so the lender, is the person who is receiving the mortgage. When they are receiving, they are called the mortgagee. So we are the mortgagor, the lenders are the mortgagee. If when we've applied for a loan and there's not enough earning capacity, we might need a little bit of help. So we might be buying a property and we need mum and dad's help with their assets to help us get our own loan. So we might need what is called a guarantor. So mum and dad might come into the role as guarantor, or someone else. So those are the three main roles, is the mortgagor, the mortgagee, and the guarantor. Sometimes, now this wasn't in the post, but sometimes we've got the terms we use of the borrower as well. Sometimes the mortgagor, I get mixed up. The mortgagor is sometimes different to the borrower, but that's a whole nother, whole nother post, let me say, in a different scenario. So I'm not going to confuse you with that. So we've got the mortgagor, you, the mortgagee, the lender, and the guarantor could be mum and dad. The third post was about important provisions that you should know about your loan agreement. So when you take out a mortgage and you get a loan from your bank, you need to know what is the security. Is it your home? Have you put something else up as security? Most likely it's the home that you, or the new investment property, whatever your case may be, it's usually what you're buying. The loan amount. How much is it that you're borrowing? This is what they call the principal amount when they calculate interest. So what is the loan amount? The loan period. How long is this loan for? If you're talking about businesses, could be a few 5 years or something. If you're talking about a home loan, their standard is usually 30 years. So they might say 360 months, which is the same as 30 years. What are the repayment terms and conditions? So you need to go through your mortgage documentation and make sure you understand what are the terms and conditions for you to make your repayments on time, the correct amount, how frequently is it happening, and all those little bits and pieces. It's also good to know what the lender's right is to charge interest. So every month you're going to be paying interest on the principal, so what is still owed. Now this could be a fixed rate, it could be a variable rate. Again, it depends on what your document says, what you've agreed to, but they have a right to charge that interest. If you default, there usually is a different interest, a higher interest, and there's other powers for the lender if you default. So it could be things like, there's different steps. They need to write to you, they need to let you know you've defaulted. There's different stages you need to go through. But the end result could be is that you've given a mortgage over your property because you're trying to get a loan from the bank. If you default, the end result could be the bank coming in, selling the house if they're just not getting the repayments done. But we're talking like a worst case scenario. So all those different things, good to note. The security, the loan amount, the loan period, and the repayment terms and conditions. Know that the lender has the right to charge interest, and know what happens if you default on your loan. The fourth post that I spoke about was lender's mortgage insurance. So sometimes you might see the acronym LMI, so that stands for lender's mortgage insurance. Now, if you're borrowing a large amount which comprises more than 80% of what it is that you're purchasing, the bank is going to want to feel that security, that confidence in you that it's all going to go well. But what will give them that extra confidence that if something goes wrong, that they are insured. So if you are going to be borrowing more than 80%, they are going to be asking you to pay for LMI, lender's mortgage insurance. This insurance basically covers them if you default on your loan. So that's what that is. If you can pay 20% of the price of what you're purchasing, there's a very good chance you're not going to be paying that. And the last post was about the process of getting a mortgage. So what we've got here, we've got 6 points. Contact your mortgage broker, find a lender, bank, credit union, make a loan application, obtain certificates of independent legal advice. I'm going to come back to that in a minute. Obtain approval, and then buy a new property. So if you go through a broker, they're able to guide you through different banks, what the pros and cons of each one are. I mean, there might be higher rates over here, but better other perks over there, or you don't want those perks, you want the lower rate. So the broker can help you do that, or you can go straight to the bank. You might have a bank that you're very happy with and you just want to go directly to them. When you found your lender, you make the loan application. They give you the mortgage documentation, which you need to sign and get back to them. They go through all that paperwork. They give you approval. Once you've got that pre-approval, you know what sort of amount you're looking at, what your borrowing capacity is. You go find a place to buy. But please please try to avoid signing contracts if you haven't got pre-approval, because that makes it very, very difficult. And it's totally another topic altogether, but if you've gone to an auction, you are stuck in that contract. There is no cooling off period. If you have no loan of pre-approval and you're at an auction, you need to have the money. Again, that's another podcast. Now, I said I was going to come back to the certificates of independent legal advice. Now, when you've got the loan documentation provided to you from your lender, they're going to ask for certificates of independent legal advice. They want to know, not have you gone through the agreement, do you understand it, sign here on the dotted line. That can happen, but if you've got the certificate of independent legal advice, that is advice from a solicitor who has gone through the documents and explained it to you. The certificate provides that statement saying that you have sought legal advice on this. So if you need any assistance with that, we're able to help you by going through your mortgage documentation and tell you basically exactly what you're in for, and answer your questions. So that's pretty much the process of going through the mortgage process. If you have any questions, please contact us. More than happy to help you out with that. And we will see you back next month. Going over this month's post, and this month's post, I'm just having a look here, is all about succession, different succession types, and your different roles, so the different hats that you can wear, so how you're able to have what you want to happen in your personal and business life, how you want those affairs to be managed, your succession in the event of death or incapacity. So that's August's posts, so we'll see you back for that then. See you later. Bye.